So what is the Fed missing that makes you believe that a more aggressive move is necessary?
I would say that a lot of the data suggests that they're falling down on.
But why is it that the Fed is supposed to be the driving seat of the US economy is using outdated data and methods?
I worked at the Fed for 9 years. So this is something that the Fed has been guilty of for a very long time.
They don't want to cut because they don't want to, A, potentially acquiesce, but B, they don't want to appear as if they're being influenced.
You hit the nail on the head. I mean, that is exactly the dynamic that we're seeing.
And what's the biggest weak point right now in the US economy?
I think the fault line, if you will, and that's how I've been describing it, is
what are you watching in the oil markets right now?
This is going to be a gut punch to US households. It's going to be a great place for Federal Reserve officials. It's going to give them something else to hide behind.
What has changed in your view, and what is Bitcoin signaling to you today that it wasn't signaling before?
Bitcoin today is telling me that we are risk on.
What's the most underappreciated risk in the markets right now?
It's something that we've already discussed.
GM everyone, and welcome back to another podcast episode here on the Coin Bureau. Now, today our guest is Danielle DiMartino Booth. She is the CEO and Chief Strategist at QI Research. She's an economist and a former Fed insider. So Danielle, welcome to the Coin Bureau.
It's great to be here. Thank you so much for having me.
It's great having you here, Danielle. So before we dive into the questions, guys, few quick disclaimers. Nothing in this episode is financial or investment advice. Please consult the disclaimer in the description for more information and consult your investment advisor before making investment decisions. Now, Danielle, I want to start off right now with your prime area of expertise, and that's, of course, the Fed. And there's many questions now in terms of what we could see in terms of potential interest rates. And in a recent interview, you said that the Fed needs to play catch up and maybe even cut by 50 basis points in June. And that's a pretty bold statement, especially given Fed futures right now. So what is the Fed missing that makes you believe that a more aggressive move is necessary?
So I think we're seeing it play out in a lot of the data on the labor market, especially. Remember, the Fed has an obligation to minimize inflation and maximize employment at the same time. We can argue for days on end about the conflict, the inherent conflict in having those two mandates. And in fact, I'm a huge advocate for going back to simply having the inflation mandate. But because they do have, by law, the employment mandate as of 1978, I would say that a lot of the data suggests that they're falling down on that employment mandate and that they're going to have to play a mean game of catch up if Kevin Warsh is indeed the chair of the Fed by the time the June meeting does roll around. Most specifically, recently we got revisions out that showed that there were net job losses in the second quarter of 2025. So not that long ago, what had originally been reported by the Bureau of Labor Statistics as a plus 77,000 for that 3-month period ended up being actually negative 371,000 for a 396,000 negative swing. We know also, due to revisions, that we were losing jobs in the second quarter of 2024. It was kind of bumpy after that. But on a net basis, the U.S. economy, when we look at it through the prism of what we call the private core at QI, the U.S. economy has been losing jobs since 2024. When you exclude education and healthcare, we do that because people are always going to get sick and people are always going to send their children to school. So when you look at the dynamism, if you will, of the private job market, it really has been moribund. And now we've slipped into net job losses across the entire private sector as of the second quarter of 2025. That was a warning that Fed Governor Christopher Waller made, was that upon revisions, we would see that actually the Fed was not evaluating the correct data when it came to satisfying its employment mandate. And indeed, that speech that he gave proved to be very prescient.
Yeah, indeed. We saw all those massive revisions last year. And I think many are questioning whether the Fed is now, to a degree, making decisions with statistical mirages to the effect of the massive revisions we saw last year. And I'm curious in terms of, because we all know that part of the reason that some of the data was delayed was because of the government shutdown, and also questions in terms of how these surveys are done and whether the data itself is accurate, whether survey data is is relevant enough at a particular point in time in terms of surveys being done. What do you think is the reason behind these massive revisions, and what does this point to in terms of how we can get relevant information for the Fed to actually make these kinds of decisions?
So I think the Fed needs to be paying attention not just to kind of long lagged revisions, but to real time revisions. Every non-farm payroll Friday, we get revisions to the most 2 recent months reported. And we've seen a record string of 12 months in a row of real time revisions to the data, such that the Fed doesn't have to say, we're in a wait and see mode. We're going to see what these annual benchmark revisions are going to be. There's no need to do that. When they see sequential revisions for 12 months in a row, we didn't even see that in 2009. So in terms of the message being sent by real-time data to Fed policymakers, it's saying you are very far behind the curve when it comes to your labor mandate. And when you look at real-time gauges of inflation provided by Truflation, TRU, which has had immense adoption in 2026 because it's now on the Bloomberg terminal. So every trader in the world now gets to follow Truflation on a daily basis. Even with the recent spike that we've seen in oil prices, the headline Truflation is south of 1%, it's about 0.9% right now. And the core measure of Truflation is sitting around 1.24%. So in real terms, in inflation adjusted terms, interest rates are very high when you consider where the Fed funds rate is compared to a measure using the blockchain beautifully, gauging 35 million prices in the United States on a day-by-day basis.
I'm curious then, as someone who knows intimately how the Fed works, why is it that they rely on such archaic delayed data, such as these delayed reports from the labor market and things like that, and also as to the other part of the mandate which you point to on the inflation side, the PCE, for example, and all the other inflation measures, when don't they have their own? I mean, Truflation, you mentioned Truflation. We know Truflation. I mean, it's a private company, proprietary data aggregator that's used by traders. But why is it that the Fed is supposed to be the driving seat of the US economy is using outdated data and methods?
Oh, so the Fed, I mean, I worked at the Fed for 9 years, and it was always a mystery to me then that there were alternative data sets that they did not rely upon. So this is something that the Fed has been guilty of for a very long time. But when you add in the element of politics and the fact that the Fed is effectively an institution that is under siege right now, right? There's criminal charges that have been taken against the chair of the Fed. The fate of one of the governors, Lisa Cook, is now in the hands of the Supreme Court. The independence of the Fed is very much under attack right now. And I think for that reason, and that doesn't make it right, by the way, I think for that reason, they now rely even more on these obviously lagged and dusty in a world of big data, in a world of the blockchain, when we know that we can get better data sources in real time. I think they are relying more on looking backwards rather than looking forwards because they're operating in a political way themselves.
It's a very good point you make. So you think that part of the partisan attacks on the Fed have led many Fed governors to try and appear as independent as possible, and therefore potentially leaning too much on these old methods because they want to point to that and say, no, we're not cutting because Donald Trump wants us to cut. We're looking very much at the data. We're data-driven, data-dependent. And as a result, they may be erring a bit more to on that side, where the extent is like they don't want to cut because they don't want to A, potentially acquiesce, but B, they don't want to appear as if they're being influenced.
That is, you hit the nail on the head. I mean, that is exactly the dynamic that we're seeing. And it's quite unfortunate because the Fed is supposed to be, they're fighting for their independence out of one side of their mouth. But at the same time, they're not acting independently on behalf of the public that they serve. This is a falling down in the Fed and its obligations to make monetary policy, as the front of their website says, for the public good. Right now, they're making monetary policy for the good of the institution, or at least that's what their thinking is. But that's not going to do the U.S. economy any good. It's certainly not going to do any small business person any good who's trying to access capital at a reasonable price and can't do so.
Mm-hmm. I want to come back to another point you raised there in terms of these political attacks, and that's on Lisa Cook and Powell himself, and the investigation launched against Powell now. And you had a interesting theory in terms of on another podcast I was listening to that now Powell will kind of be obstinate to the extent that he's going to stay on as a Fed governor. And because even though he was potentially out the door after his term ended, now he's now going to dig in and he's going to I'm actually going to now and stick it to these guys. Similarly, Lisa Cook, who it seems the court may side on her, fall down on her side, may also now be a kind of rebel. So you've got now two potential rebels who are going to fight against the monetary policy of the chair just because they were slighted or attacked. Do you think that's likely to impact on the way the FOMC votes and the increasingly make the Fed even more partisan than it really is?
I think that the risk is definitely there. On a practical level, however, Senator Tom Tillis, who's going to be leaving office, he's from the state of North Carolina. He, as a standalone, as one individual, can stop the ability even for the Senate Banking Committee to make a vote to even allow Kevin Warsh's nomination to proceed to the broader Senate floor. And he has repeatedly stated that he's going to dig his heels in until these criminal charges against Powell are dropped. So it's last check, it's March. And in theory, Powell is out within 2 months from where we are today. And we haven't even been able to bring a vote to the committee in order for it to go forward to the full Senate. So it remains to be seen if Powell stays in place simply because there's no successor. And that could, again, I don't see any signs of the administration backing down on these criminal charges. And I don't see any sign of one senator acquiescing and allowing the vote to proceed.
Yeah, it's very interesting. So let's say we're in June right now, and the Fed decides it doesn't cut. What do you think could happen? What's the biggest weak point right now in the U.S. economy?
I think the fault line, if you will, and that's how I've been describing it, is private credit. And I think that that's something that we've seen. We've seen record levels of bankruptcies in terms of the growth rate of bankruptcies. People forget the first lesson that I was taught when I joined the Federal Reserve, and that is that the lag effect matters. And we still, for companies that rely on a zero interest rate policy, we still have many companies that are suffering from what they consider to still be higher for longer Fed funds rate. And that is causing major disruptions in the private market. We see it in Chapter 11 filings, but it's causing disruptions because we can't see the prices of the underlying portfolio companies for some of these private credit companies. And that alone has sent shivers down the spine of global markets recently. And in fact, it's one of the reasons that we saw the benchmark 10-year Treasury yield break 4% to the downside. It's back to about 4.08% after the attacks on Iran and Iran attacking right back. So we have seen some upside, but the reason that we actually saw the 10-year dip below that 4% mark after a very long time was because of fear that we're going to see some kind of a liquidity crisis, something along the lines of a credit event, as we call it, emanating from this private credit space that's grown from about $500 billion to almost $2 trillion in the space of a few years.
And we were talking just before the stream that you're actually giving university lectures on the private credit stresses right now. And I think more recently, it seems to be picking up pace in terms of the concerns in the private credit market. I mean, today, I think we saw that, I believe it's Blackstone, one of their funds, one of their flagship funds, is now seeing lots of redemptions. There's Blue Owl Capital and a few others. What do you think are the risks, not just for the broader market, of one of these private credit funds going under and facing these credit stresses?
So I think that the real risk is that, as is the case with every single cycle, when you feel like you're not getting enough in the way of fresh funds, you turn to the retail investor. And that was exactly Blue Owl's business model from day one, that they brought in high net worth investors. When you start to put gates up and when you start to restrict redemptions, then you can cause a panic in the markets that then spreads to other areas where individuals feel, okay, so I'm going to sell this because I can get liquidity because I cannot get liquidity from that. And so the real risk when I talk about a liquidity vacuum is that we see a contagion effect in other asset classes simply because individuals can access funding by selling off other assets that are more liquidly tradable than where they're seeing you can no longer make a redemption request, or we're going to restrict redemptions.
Interesting. In terms of maybe you know the exact stats, but the investors who've been investing in these credit funds, how much of them has been on the retail and individual side versus other investment funds and institutions?
So again, the Blue Owl has been the case since the inception of the company, that they were bringing in high net worth investors from day one. The advent of the retail investor through the conduit of the 401k contribution, that's very new. But the SEC is not exactly in kind of a dirty, hairy enforcement mode right now. And they've allowed basically all entries to barrier to come down for the retail investor. There's been a lot of pressure through lobbyists, through private equity, big firms, because they've seen several years where they have not been able to raise funds from institutions. And so that therefore they're having to rely more and more on the retail investor. We don't know exactly what the footprint of the retail investor is inside of these funds, but we know that absent institutional fresh funding coming in, that they're relying increasingly on the retail investor. And again, this is something that we've seen at the end of every cycle. When in doubt, when you can no longer access liquidity, just bring the retail investor in.
Interesting. Do you think that they should have allowed, the SEC should have allowed this, to the extent that, do you think retail investors should have been investing in opaque private credit funds?
No, I think it was highly unreasonable. I don't think that these investments are suitable for smaller investors when they, by their very nature, have liquidity needs come up unexpectedly. When I was on Wall Street, I worked at an investment bank that was in the private equity space much earlier than other investment banks, before the advent of all of these giants that we see today, Blackstone, KKR. I was at a bank where it was very much in its youth, and at that point, you'd have to be able to substantiate that you had several $1 million in liquidity before you could be considered as a qualified investor to come in and take a spot in one of these private equity funds. Several $1 million in liquidity.
Mm. And on the other part of the equation, in terms of the firms that have been receiving credit in terms of loans from these funds, and do you think that if the private credit bubble pops and then they're not going to be able to access the funding they used to, do you see that as a potential risk as well? And what sort of impact could that have on these companies? I mean, a lot of them are, for example, software companies, which is part of the reason why these credit funds have been had the redemptions, the requests.
Right.
But what do you see on the other side of the credit equation?
So I think the greatest risk is not necessarily in what we know, because we know that software is at risk from AI, that it's an existential risk, but that what we're discovering on a weekly basis, the other areas of the economy that AI can effectively disrupt. We saw transportation stocks, for example, which you wouldn't think of as being a go-go sector, really take a hit a few weeks ago when we learned that AI was able to come into a freight company and increase their volumes by 300 to 400% without increasing headcount by one person. So those are the kinds of disruptions that start to bleed into other areas. But again, so much of this financing for AI, unlike what the case was maybe 18, 24 months ago, is now leverage. And so much of it is coming from the private credit space. So you're seeing the intersection, if you will, the juncture of the AI leveraged trade colliding with increasing instability and decreasing credibility in the private credit space.
Yeah, mentioning the leverage within the leverage taken on by these AI companies, and not necessarily related to private credit itself, but public credit, in terms of some of the massive amounts of debt that has been raised by the hyperscalers in the like the Googles, the Microsofts, the Facebooks, etc. Where do you stand on that in terms of is this sustainable? Is it a worthwhile? Do you think that there are potential risks here that taking on massive balance sheet risk? And what are the potential side effects for the economy if, whichever way it goes?
Well, 2025 was a unique year. The U.S. economy, its economic output, its GDP is 70% consumption. That hasn't changed. So to see that that AI was a greater contributor to GDP in 2025 compared to that of consumption, the lines actually crossed one another, was very disturbing, because you say to yourself, how concentrated, how reliant is the US economy on this one sector for its growth? Now you add leverage on to the discussion, and the fact that, again, I'm here in Austin, Texas. I've been speaking to university students, including engineers, and they haven't been able to convince me that a lot of the investments in AI won't harvest and become irrelevant in a very rapid time frame, because there's always the next chip that's coming online that can do that much more with that much less than the prior generation of chips. So, and the other interesting question that I've been asking of the scientists and the computer scientists of the world is, why on earth does the United States need 11 times the data centers of the next largest country, say Germany or China? And nobody's been able to provide me with a credible answer to that question as to why we need so much more when other countries have clearly adopted AI. Some have done it in a more efficient fashion in the United States. Some have seen better execution than what we've seen in the United States, with much less in the way of infrastructure and investment into data centers. So I go back to the term that I've been using increasingly, which is a fault line. I see this as being a major fault line for the broad U.S. economy, for the global economy, and for the credit markets.
Yeah, it's a great point you make, because I read a fascinating statistic the other day, and that's like the amount of space required by data centers now is now overtaken the space required for office square foot. So basically, AI data centers for machines is taking up more space than office workers.
And initially, when one of these data centers is constructed in somebody's backyard, it creates construction jobs. And that provides kind of a small boost to the economy. But I've seen some data centers are able to operate with 10 employees. Some data centers at the very high end can operate with 40 employees. It's not, when you consider that you've just compared offices to data centers, they're not something that necessarily generate returns for the real economy. They're not creating massive numbers of jobs. In fact, they use fewer employees than any sector that I could possibly identify, at the same time that offices themselves are being hollowed out. And we're seeing, and that is another area of stress for the banking system right now, we're starting to see some serious price discovery in commercial real estate as the recognition comes about that it's just going to be the toniest office buildings, the ones with elevators that talk back to you, that we call them the A+ trophy skyscrapers, buildings that are holding their value. And we're seeing 87% losses, 90% losses on other buildings that are changing hands. And I bring this up not to take a deep dive into commercial real estate necessarily, but to point out that for every loss that's realized, banks have less in the way of latitude of making other loans into other areas of the economy, to the extent that they're withstanding more and more losses. The same could be said for the consumer loan book for banks as we see delinquencies rise.
Yeah, that's a very good point in terms of how a lot of the growth has been driven by AI, right? And this relates to, for example, the big question, and you talk a lot about this, and it's become a big term now, is like the K-shaped economy, and how you see in this growth and GDP and the expansion of AI companies, and then on the other end of the spectrum, just normal labor market and jobs in the middle class are being squeezed. So I'm curious in terms of like this weakness now, is it starting to spread from the lower income and credit strained parts of the economy into areas that had previously looked resilient?
Oh, absolutely. In fact, in the aftermath of the pandemic, if you looked at the areas where there was the strongest wage growth, it was actually with some of the lowest skilled workers. They were the hardest to get your hands on, because the United States government pumped out $15 trillion in stimulus spending in a very short period of time, a lot of which went to pay people's rent for 19 months, or extraordinary levels of unemployment benefits, or moratoriums on foreclosures, or not being able to collect people's auto payments. a 5-year stay on student loan repayments. All of these things fed into very high wage inflation for the lowest skilled workers at the same time that we were seeing companies begin to cut back on their white collar workers, which is a phenomena that typically is not how labor market recessions begin. Normally, you see the lowest skilled workers get fired first. And this time around, we've actually seen that hit the middle management, the middle income earner, the hardest first. I mean, the first huge announcement from Amazon that affected 10,000 workers, those were corporate employees. And we've seen one round after another. And the risk with AI going forward is that there's going to be a continuation of this hollowing out of the middle income worker. And that's why we've seen the gig economy, as robust as it is, offsetting a lot of the job losses that we've seen, and why we're seeing underemployment, for example, for college graduates in the United States, ages 22 to 27. The underemployment for this cohort is about 42%, because they're discovering that the value of the 4-year degree, that the internal rate of return on that 4 years of investment is not worth what they thought it was prior to starting at university, because they can't get the entry-level jobs that they were expecting to get because they've been completely displaced by AI. So these are questions for the US labor market. There's certainly issues for the Federal Reserve to consider, but they're also societal issues for us to consider in a midterm election year, but much more importantly, looking out over the horizon at the 2028 elections, given what we've seen in some of the smaller elections around the country.
Just in terms of underemployment, that term, does that mean then people who aren't in full-time jobs are just working gigs, who are trying to make ends meet in other ways?
Underemployment can also mean that you're taking a job that you're extremely overqualified to take. It's something that creates a lot of anxiety. And we have to bear in mind that when you add up the two generations of millennials and Gen Zers, you get to 52.5 of the voting population of the United States. That's a big voting cohort. We saw what happened with the New York City mayoral election, and you could easily extrapolate, if AI does not begin to offset with some of the job destruction that it's causing with job creation in a short period of time, you could certainly see voter anxiety manifest at the polls.
Yeah, there is a lot of pushback. And in terms of where this could go, I mean, one of the more dystopian realities that, I don't know if last week, if you managed to read the Citrini report, basically came out, it was kind of a doomer report, to be fair, that envisioned in 2028, where you've just got all the white collar workers being pushed out, and then they're now competing for the lowly blue collar workers' jobs, and now you've got a race to the bottom in terms of salaries. I mean, do you think we could be heading to that dystopian reality without changes in terms of policy?
I think that policy definitely has a place in terms of where we're headed. I don't know that it's possible to kind of derail technology and its advent once it's left the station. I guess my answer would be, I certainly have hope and optimism for the future of what AI can deliver, but I've yet to see tangible demonstrations of what that's going to look like in terms of job creation in the private sector. So when you had the cotton gin, when you had the microwave, when you had the VHS player, when you had the World Wide Web and the internet, they ended up being net job creators. And we can look back in history and say there was a bump along the way, and the horse that used to pull the buggy was displaced by the automobile. But we all created more jobs, and the real economy in the end benefited to a great extent in the aftermath. And we're sorry to the horses that no longer could pull the buggies, but the greater good, the entire public, it raised middle class incomes at the time. I've yet to see a credible demonstration. I've heard lots of theories, but I've yet to see it demonstrated how AI is going to be anything more than, I can squeeze more out of one given employee than I used to be able to get out of three.
Yeah, that's true.
And I'm not trying to be dystopian. I'm not trying to validate what Citrini was saying. I'm just saying I'm in a wait and see mode to see what the productivity miracle is going to look like, aside from the remaining employees of any given firm feeling like they've got a gun to their head and they better produce more and they better figure out how to do it with AI. Because these decisions are coming from on high, from the C-suite, from CEOs, from CFOs. And they're saying it's time to bring AI into our company, which is great, unless you don't know how to do it. So and the execution often leaves employees feeling like, if I succeed, am I replacing myself with a machine?
I'm curious though, because it was another point which was raised in terms of a lot of these job cuts, especially on the corporate side, like for example, Amazon and a few other big companies, is that, and this is what Sam Altman has said, is that part of these big corporates that had been over-hiring post-pandemic or during the pandemic are using AI as a sort of an excuse, right, to basically get rid of jobs that just were planning to cut anyway. Do you kind of agree with that, or what's your view on that?
I completely agree with that. I 150%. There was so much money swashing around out there after the pandemic. It was so difficult to source employees that a lot of firms overhired. And debt was free for a very long time. Interest rates were set at the zero bound. There were really no penalties for overhiring. But now they're finding out that right sizing is long overdue. Many of them also found out through the Great Resignation and so many employees refusing to come back into the office and declaring, I can work from anywhere, which is completely feasible if you're a fully productive worker and you're actually working. But a lot of CEOs said, I can save 2/3. And if this employee can work from anywhere, then I can just send that job over to Mumbai just as easily, because I can put a law library on a chip and send it overseas as long as somebody is proficient with English. And that's been one of the quieter trends that we've seen in the post-pandemic era, is the offshoring of kind of middle income, high income paying jobs. And when you overlay that with AI, you start to ask yourself, where are these new high paying jobs going to come from, if not from electricians? I read an interesting article that data center construction has been upheld because there aren't enough electricians in the United States that can wire these data centers and get them up and running. So I'm all about trades and training more people, and for every time a plumber walks through my front door, not having to pay him $200 to cross the threshold and seeing a 58-year-old man. I'm all over that. But will that be enough? I don't know. And are Americans willing to take these kinds of jobs?
That's a good point. Exactly. Yeah, because it is the case that if your entire education has been one that has been into a profession or a white collar profession, and now that job is no longer there for you, are you willing to like roll up your sleeves and do a job of a blue collar worker? And I guess this comes to the question I have in terms of what is the solution here? Because if you are to assume that the trends of technology will go the way they are, how would you alleviate the plight of the underemployed young people coming out of college who are disillusioned, who have massive credit card debt, who are using buy now, pay later just to live, and who are increasingly just facing a financial precipice? Like, what is the solution in terms of policy?
Gosh, I wish I knew. I wish I had the beginning of an answer to that question for you. So I was speaking to some seniors who are going to be graduating in May, and a lot of them were saying, what am I supposed to do? Where am I supposed to go? And I do think that it's interesting to look at the intersection of trade and business and understand that a lot of the people who've trained to be business owners, business runners, they've got good accounting skills, they've got good marketing skills. It is interesting for me to suggest to them, well, maybe you should be starting an air conditioning HVAC company. Maybe you should be running a company like that. Maybe you should be looking at areas of the economy that are going to be growing over the next 15 years. Maybe you should be focusing on aging out baby boomers and the fact that there's such a need for ways to deliver healthcare to this aging population, and you've got business knowledge about how to do it. I'll surprise you right now and tell you that the highest area of distress in private credit is not in software, but it is in healthcare, which most people, I mean, private credit came in and they bought things like nursing homes and senior living facilities and doctors' practices, and then they cut them to the bone in terms of the ability to deliver the care and loaded them up with debt. So that's one of the largest areas that we've seen in bankruptcies, which is counterintuitive because we've got the aging of America. So I try and tell young people to open their eyes and look at, in terms of where's my future, at what can AI not do. They cannot build a highway. They cannot repair a bridge. And there's serious money to be made in some of these professions. And while it may require a few years of retraining, that is some place where the government could step in and help these younger individuals by providing pathways to gaining the skills that they need to combine with the university degrees that they already have. So there are sources of demand.
Yeah. Do you think that someone who has worked or studied, taken on exorbitant amount of student debt to go and work, study for a profession that they can't get a job in, would actually then consider doing something in blue collar work? I mean, is this? What do you think?
It really depends on whether or not they want to live with mom and dad. And again, there's something to be said for reigniting the hunger to work in this country. We've had several generations who've not thought very highly of work. But I can tell you that the 18, 19, 20, 21-year-olds, to answer your question, they would say, yes, I'm willing to do whatever it takes to make a living. And that's the kind of go get 'em attitude that you've got to have in the current environment. And the youngest college graduates are indeed of a different mindset than, not to paint with a broad brush, but than that of a lot of the Gen Zers and a lot of the millennials.
And what do you think in terms of the potential policy solutions that are being, touted by a lot of these progressives, especially on the socialist angle? You mentioned the New York City mayor. I'm curious if do you think we're going to see more of this shift towards the left, and especially among the younger voter class?
Again, Gen Z and millennials make up 52.5% of US voters. For decades, it was the baby boomers, but now they're outnumbered. And I have no harbor at all for socialism. I lived in Caracas, Venezuela, before Chavez rose to power, and I've seen in the aftermath that socialism is only as good as being able to spend somebody else's money. I don't think it's the solution. I certainly don't think it's what our founding fathers would have envisioned, that we fall back on fiscal policy to support us. But I think it's a real risk. Okay. I think it's a real risk if we don't get policies that are more geared towards helping some of these disenfranchised young people find a pathway to new types of careers. And there are places for the government to step in and accelerate that process. And this would require people in Congress to actually stop and think, which is maybe a tall order. But
tall order indeed, yeah.
On a higher level, we also need leaders that have the interest not of themselves or their sons or their friends or their cronies or the biggest lobbyists. You have to have stronger leaders who have the best interest of all of their constituents at heart, as opposed to their children and friends.
Yeah, that is a bit of a tall order. I mean, we can hope. It's good to be optimistic. So just moving on now back to a bit of monetary policy, and this ties into the other mandate of the Fed, inflation. And you mentioned Truflation now, obviously indicating that it's trending lower and all that. But recently, in fact, over the past week, we had a bit of a shock on the supply side of one of the components in the CPI calculation, which is energy and oil, because we recently had the strikes by the US and Israel on Iran. And it's now leading to a growing disruption in the Strait of Hormuz, which carries roughly 20% of global oil supply. And markets have already repriced this energy risk, and oil has rallied sharply. What are you watching in the oil markets right now, and how do you see this geopolitical escalation feeding into broader macro dynamics like inflation, but also growth expectations and risk premium in general?
We're certainly at an interesting juncture. When you look back at Kuwait or Iraq, you find that these oil shocks don't tend to be long-lived. Of course, it all also hinges on where you live. The Europeans have seen an 80% spike in natural gas prices. They're net importers. So the fact that the United States energy complex, that we've become energy independent, is critical, and it also helps explain the great divide between West Texas Intermediate and Brent crude oil prices. On a higher level, I think that headline gains in inflation that we do see, and I can promise you that if I go out on any major thoroughfare today, that the price of gasoline per gallon is going to be a heck of a lot higher than it was just 2 days ago. And those prices are passed along very quickly, and they come down very slowly. So they're sticky on the way down. Against a backdrop of ADP telling us that the wage gains made by job switchers hit the lowest in their records, and other data points that show us that wage disinflation has taken hold, this is going to be a gut punch to U.S. households. At the same time, it's going to be a great place for Federal Reserve officials who want yet another excuse to not lower interest rates. It's going to give them something else to hide behind and say that until the fog of war clears, and until we know that this hasn't had a substantial impact on inflation, and more importantly, Treasury Secretary Scott Bessent coming out just today and saying, nope, we're going to have 15% tariffs by this week. If that's the case, then you're looking at more margin compression, more layoffs as a result, and U.S. households being squeezed to an even greater extent. It's a toxic mix. It really is. And the ones who will end up losing the most in the end are small business owners who can't hold on anymore.
Yeah, it's a terrible confluence of events right now. And I think, do you have any perspective in terms of where oil prices could go with this disruption? I mean, I know that I've seen Goldman Sachs has updated or reinforced their prediction of about $100 per barrel oil in the next few months. Do you have any thoughts on where we could be seeing oil go because of this?
Well, I mean, so the first submarine to down a warship since the World War II tells me that we militaristically may have the upper hand here, and that this might not be a long, drawn-out conflict. In fact, we've seen oil prices fall today, not to rely on one day of trading in isolation, but we certainly haven't seen the predictions over the weekend manifest in the form of $100 oil. $108 oil was the other prediction by Bloomberg economists. We haven't seen that kind of upside. The fact that we've got West Texas under 75 and Brent hovering around 85, I don't think most people, even a week ago, would have suggested that they would have been so well behaved. But again, this is a military conflict, and Iran shot a missile into a NATO country, into Turkey.
Oh, yeah.
And so when you start to get, and the things like the bombing of the embassy in Dubai, when you start to have a consensus of countries that are saying this is not good, then you can also predict that the conflict itself is going to be shorter lived than what would otherwise be expected.
Yeah. And just another, not to stay on the geopolitical angle right now, but just curious, because you mentioned you used to live in Venezuela, and I'm curious what you think in terms of the impact of the takeover or the in Venezuelan oil markets by the US. Do you think this is going to have any impact on the energy markets? What do you think the angle was there?
Well, I think the angle there was more global trade related, actually, because when I worked in Venezuela, I worked in natural resources. So I know a thing or two about their ability, their capacity, the state of their infrastructure, the state of their oil pipelines. It's going to require hundreds of billions of dollars to begin to find relief from Venezuelan oil. Some companies managed to stay the entire time. Chevron still had feet on the ground. Some companies will be able to realize the benefits of having access to Venezuelan oil earlier. But by and large, it's going to be a very long, drawn out process. My view on Venezuela was the failure in the Panama Canal. And so if you want to truly fight a quiet stealth trade war with China, then you control the seas over which they conduct trade and commerce. And that entails the Panama Canal, which Venezuela is about as close as you can get in terms of a convenient country. Chavez, Maduro, they should have been taken out years ago. Why now? Well, because it was politically convenient, because you're trying to get control of the Panama Canal. And if you want control of the other waterway over which China can send tankers, well, then maybe you just, I don't know, bail out Argentina and go that route as well. So I'm not one who believes in coincidence when it comes to why the United States does what it does, but Venezuelan oil ain't it.
Interesting. The term that now being bandied about is the Donroe Doctrine. If the fan of history, the Monroe Doctrine is now Donald Trump's broader sphere of influence over the Americas. So Danielle, this is obviously we've been talking a lot about the macro, but we are a crypto-focused channel and podcast. But so I'd like to get your takes on a few things there as well. I mean, you're not specifically focused on Bitcoin or crypto, but you recently did say in a podcast with Nat Brunell recently that you're tracking Bitcoin more and more closely than ever before. So what has changed in your view, and what is Bitcoin signaling to you today that it wasn't signaling before?
Well, Bitcoin today is telling me that we are risk on, that there is a lot of enthusiasm. It wasn't but a week ago that we were flirting with 60. Now we're flirting with 75. And it's become an excellent barometer of risk appetite because it never closes. So you can get a feel on any given Saturday or Sunday for where risk appetite is globally. So when I see that it's up 8% in one day and trading like a hockey stick, that tells me that there's been a reprieve on everything we've just discussed, on macroeconomics, on the perils of private credit, on the risk of a liquidity vacuum. It's a perfect reflection to me of I actually don't need to look at other markets. I can just look at Bitcoin's price and tell you right now that bond yields have probably ticked lower and the stock market's probably much higher.
So it's a good indicator.
Which it is much higher. Sorry, I was looking at Bloomberg TV.
Yeah, fair. A great synopsis of what's going on in the market. Just take a look at what's happening with Bitcoin. But it's interesting because Bitcoin, Bitcoin adherents and maxis would have the argument that, Bitcoin's supposed to be the ultimate risk-off hedge, the ultimate safe haven, the best debasement trade there is. But it's just hasn't been trading like that, especially over the past year. I'm curious why you think that is. Why is it that asset allocators would invest in Bitcoin as if it is risk on when fundamentally as an asset class, it is analogous to a gold in the sense that it's got a capped supply and it is limited in supply and all these other factors that people would invest in a risk-off asset. Why has it got this high correlation with equities, and why do asset allocators allocate according to that?
I think they do because it tends to move in the opposite direction of gold, or at least that's what has been the case of late. Again, I've never been one to talk publicly very much about the underlying theories that drive acolytes of Bitcoin, but I am a 30-year veteran of the financial markets, and anybody can identify a barometer, and a really successful barometer at that. And that is what Bitcoin has come to be.
Yeah. Fair. So Danielle, we just want to finish off this pod episode with a few more light-hearted questions, just to.
Sure.
Um, I want to ask you one question and a few rapid-fire ones. So, firstly, what's one economic indicator that you follow that would sound completely boring at a dinner party, but that you secretly love because it never lies?
So actually, that's the MOVE index. If I just had one economic indicator, that's the volatility of bond trading, treasury bond trading. If it goes too high, it starts to flash credit risk. But if I really want to make somebody's eyes roll into the back of their head at a cocktail party, I'll bring up non-depository financial institution lending, and tell them that I walk around talking to my friends every day, all day about NDFIs, and they'll be like, "Whoa, I am going in the opposite direction of this woman."
Non-depository financial institution lending.
Non-depository financial institution lending. So if you look across the U.S., the entire spectrum of U.S. banks, the growth of banks outside of non-depository financial institution lending has been flat. It looks like a flat line on an EKG. NDFI lending has gone absolutely through the roof, and that is the conventional banking system lending to the non-banking system. So the idea that one is not attached to the other is it's naive at best. And when people ask me what I think the greatest risk is, it's that regulators have finally come to an understanding that they've got a real problem with the big banks lending into the shadows at massive rates, but they don't know what to do about it.
Yeah.
Just like they didn't know what to do about credit default swaps and derivatives in 2007, 2008, before AIG blew up the world.
Yeah.
So my greatest risk right now is regulatory ignorance.
You got it. Well, that wouldn't sound completely boring at the dinner party, especially the way you've described it. I would actually find that quite interesting. So, I guess it's just different kinds of interests. And now, sort of some quick fire questions. What's a question about the economy that you wish someone would ask you, but almost nobody does?
I wish people would ask me what job creation has done since 2024.
Okay. Why is that?
Well, because revisions have revised away a whole bunch of it. And yet, to listen to the talking heads and the sell-side economists, the labor market's strong, it's solid, whatever word you want to attach to it. But when history's been completely rewritten, it sure would be nice if a lot of these people could be accountable for having not seen the trends by talking to people on the street and by seeing the growth of the number of Uber drivers. That's not just a mistake. It's people who are desperate for any kind of income.
Okay. What's the most underappreciated risk in the markets right now?
It's something that we've already discussed, and that is the big hyperscalers borrowing through the private debt channel.
Got it. And then finally, related to AI, is it inflationary or deflationary long term?
To be determined.
TBD.
It's going to be deflationary for quite some time.
Okay, TBD. Well, thanks, Danielle. This has been a great chat, and there's so much more that we could have covered, but it will just mean I'll have to get you on again sometime soon. Where can our audience follow your work?
So we publish every trading day of the year, DiMartinoBooth.substack.com. We publish the Daily Feather. I love all of our readers. If you're an institutional investor, QI Research, we've got a booming Bloomberg chat room that's always interesting. So look up QI Research. And if you don't already follow me on the platform we used to call Twitter, please do, at DiMartino Booth.
Cool. We'll leave to all that down in the description below. Thanks again, Danielle. Really appreciate it.
Thank you.